So my name is Travis Trim. I'm the president and founder of the Finance Association of Laurentian University. I'm a third-year Bachelor of Science in Actuarial Science and Finance student at Laurentian. I'd like to say thank you to our guest speaker, Fred Pinto, for collaborating with the Finance Association of Laurentian University. I'd also like to say special thanks to my uncle, Christopher DeSantis, for introducing me to Fred. This wouldn't have been possible without that networking. Okay. So I'd also like to say thank you to our volunteers at FALU for assisting us in creating such a wonderful event for students, professors, and professionals. In particular, I'd like to say thanks to Jason Sokolsky, our vice president, and managers Nil Patel, Michaela Sheehan, and Emily Plater, and also to our associates and senior associates, Shrey Aurora, Nur Hassan, Jacob King, Alicia DeWert, Brandon Roy, Jessica Ville, Sylvanis Santosh, Nathaniel Gupel, and Nicola Howard. I'd also like to say thank you to all the universities who are in attendance today. We have obviously students from Laurentian University, Cambrian College, Rotman at University of Toronto, Wilfrid Laurier, Dalhousie, Schulich School of Business, Ivey Business School, Fanshawe College, University of Ottawa, Carleton U, University of Calgary, Ryerson, McMaster, University of Waterloo, University of New Brunswick, Cape Breton University, King's, University of Moncton, HEC Montreal, Humber, Vancouver Island University, University of Alberta, Algoma U, McCowan, Trent U, Centennial College, Thompson Rivers, U of G, and Stern School of Business at New York University. I'd also like to say thank you to the corporations who are in the house today. Of course, some of Fred's colleagues at Aviso Wealth, which I noticed from the registration list. We also have attendees from Goldman Sachs, State Street, CFA Institute, RBC, Deloitte, Overbay Capital Partners, Concentra Bank, Cambridge Global Payments, BDC, and Scotiabank. And some of these participants are even joining us internationally today. So from our whole team, thank you for joining us from all over the world. So without further ado, let's begin the event. As you already know, our guest speaker today is Fred Pinto. Fred Pinto is head of asset management at Aviso Wealth, a fully integrated wealth management services firm with over 90 billion in assets under administration. Fred is a CFA charter holder and is past chair of the board of CFA Society Toronto. Through the CFA Society, Fred is a member of its governance and nominations committee. Fred holds a BA honors from the University of Toronto and an MBA from Ivey Business School at Western University. So thank you for joining us today, Fred. I'll let you take the floor now.
Wonderful. Well, thank you so much, Travis. And you are absolutely right. I have to thank your uncle, Christopher DeSantis, and it seems a little odd calling him your uncle, not because he's not your uncle, but because I've known Chris for well over 20 years. And quite frankly, we grew up together in the asset management industry, and he's a wonderful friend, a wonderful supporter of the business, and certainly gave me the opportunity to meet you and the Finance Association of Laurentian University. And I will say, folks, I am thrilled, really thrilled to be speaking to you today. When you started going through all the various universities and the various organizations, I thought to myself, man, I'm getting nervous here. I'm getting nervous. So many people on the line. And I think one of the things that I would say is in this Zoom world and in this video world, we are perhaps a little less conscious of how we interact and how we react with people because we don't actually see each other live. And quite frankly, if I was speaking in front of 108, 110 participants, I'd be getting a little bit more nervous. But I'm going to keep it very casual, very interactive. I know Travis and team, you guys have a bunch of different questions that you'd like to pose to me. I'll do my best, my very best to answer those questions. But what I wanted to do is just touch on perhaps a couple of things. You talked about my background, so I'm not going to talk about that. In fact, that's the boring stuff. I'm going to talk about really two things in particular. Number one is I want to talk about the rise of ESG investing. Few things in the world get me more excited than the rise of ESG investing. It really is our time to be able to grow and develop this type of investing. I want to talk about that. And then I also want to talk about why it's important to me from a personal perspective. So let's talk a little bit about ESG investing. ESG investing, it's actually called responsible investing. Responsible investing has been a category of investing for many, many years. And what it is in its most basic terms is it's the incorporation of environmental, social, and governance factors within the investment decision-making process. And that's a definition of responsible investing in its most basic sort of terms. Essentially, people will say, well, Fred, why are people invested in ESG, and why are they so keen about this process? And really, from my perspective, there are three elements. Number one is by incorporating ESG factors within an investment process, it has been proven in countless studies that improves the risk-return profile for an investor. There have been many people over the course of many years who have said, well, by definition, and there are a number of CFAs or CFA candidates here, I'm a CFA as well, and the old school way of looking at this would be to say, well, Fred, by excluding certain securities and certain types of investments, then by definition, you're limiting your universe of investments, and therefore you're going to underperform. And what research has shown us over the course of the last several years is that actually enhances a risk and return profile, because there are certain ESG risk factors that are built into financial valuation models. And by incorporating those risk and return factors, your valuation, your return potential is actually higher. So that's one group of investors, those that say, you know what, I'm looking at this from what I would consider to be a mostly rational perspective. It's an investment rational perspective. The second group would be those that are attracted to responsible investing for personal reasons. And historically, there were a lot of faith-based and religious organizations who looked at ESG investing and they said, look, this aligns with who we are as organizations, who we are as people. You know, they're excluding certain sectors like tobacco and weapons. And that aligns with our personal values or our values as faith-based or religious organizations. And so that's sort of the second bucket of investors and individuals who are interested in ESG. And the third, and this quite frankly is what gets me excited about responsible investing, because I think this group of investors, and I hope it's many of you here on the call today, are the ones that are actually going to build up the industry for the next 10 and 20 years. And those are the investors and the individuals who say, you know what, I want to make an impact. I want to make an impact, not just with my investments, but I want to know that my investments are having an impact in the broader society. And to me, that is what gets me excited about ESG investments and the ESG space. Now, the ESG space, just to give you some context, it's not a niche. It's not a niche space. There are roughly $40 trillion worth of assets in ESG globally. In Canada, the market is roughly $3 trillion. Growth rates are tremendous. In fact, one of the recent studies I saw, it was actually from PwC in Europe. They called ESG and responsible investing the next biggest thing since ETFs. And we all know the success of ETFs over the course of the last several years, not just in Canada, but globally. And so the market is increasing. Lots and lots of institutional investors are pouring countless trillions of dollars into this market. And what to me the catalyst was last year was some of the fundamental social change that we saw, not just in Canada, but elsewhere. I think what that caused is it caused investors to say, you know, can we be doing more with our investments from an impact perspective? And that's something I think that resonates, as I said, with me. And I'm going to get to the personal thing in a couple of seconds, but what I did want to land with you, and I know this is this event is sponsored by the Finance Association of Laurentian University. So I want you to go back to your first year finance course, and I was in a finance course when I did my MBA program, and I remember sitting there, and the professor came in, and it was a gentleman at the time, and he said, you know, purpose of a corporation. And so we're all there, we're all keyed, and he's like, a purpose of a corporation. And it was, of course, the line that I think we have all heard many, many times: maximize shareholder value, right? That came in decades ago, but quite frankly, we have outgrown that old school framework. Today, the purpose of a corporation and the purpose of a company is much bigger than that. It is anchored in what we call the stakeholder theory of a firm. And that is to say, an organization or a company is there to serve many interests. It's there for sure to serve its shareholders, but it's also there to serve employees, customers, build better value chains with its suppliers, and importantly, to serve the communities in which they operate. And from my perspective, one of the ringing endorsements of that stakeholder theory came out a couple of years ago from the Business Roundtable in the US, and it's a group of leading CEOs of large organizations. And 20 years ago, they talked about the purpose of an organization or a corporation was to maximize shareholder value. Well, 20 years later, fast forward to 2018, they said the purpose of an organization and a company is much broader than that. And that, quite frankly, is how we anchor our views in responsible investing and ESG. It's based on that notion of companies are much more than just catering to the needs of their shareholders. So that's why I'm passionate about ESG from an industry perspective. Why I'm passionate about it from a personal perspective is I've got a couple of kids. And from my perspective, they have tremendous futures and opportunities. And as a father, but also as a professional, I want to leave this environment, this place, in a much better spot for them to grow and flourish in their careers. And so that's why it's intensely personal for me. And so with that, what I'm going to do is I'm going to turn it back to Travis. I know you've got a ton of questions here. I'm happy to address any and all of them. I will say it's been a while since I've been in the capital market, so I'm not going to give you any views and prognostications in terms of where markets are going to go. I'll comment a little briefly on it, but happy to take whatever questions you may have. And so Travis, with that, back over to you.
So this question comes from myself, actually. So I really want to know what your take is on the rising yields and the recent tech sell-off, and actually the very recent recovery, very short-term recovery of tech. So what do you think this is a short or long-term trend?
That's right. So Travis is going to put me on the spot immediately here, right? He's going to ask me for my fearless investment forecast.
I had to ask because, you know, when me and the team were discussing this, we said, what's the hottest thing in the market right now? And we like to be current. So I had to.
For sure. Well, so I will say I talked to our investment guys, and here's their view. We're in an uncertain environment right now, right? We're in a choppy environment. Yields have gone up. The 10-year yield has gone up dramatically over the course of the last couple of months, and in fact, in the last month or so. And it's based on the expectation that we are going to see inflation and the economies are going to rally globally in the U.S. and Canada with the vaccine rollout. And you know, there's really, I would say, a feeling of optimism and pent-up energy that all the restricted economic demand that was there in the second quarter, third quarter, fourth quarter of 2020 is going to be unleashed. And we would say we broadly support that, but we think it should be tempered by the fact that there is enormous liquidity boosting up this enthusiasm and these yields. Our view would be that we're probably running a little ahead of where we are. I wouldn't be surprised to see some sort of a correction or some sort of a downturn at some point during this year. And I would say that, while 2021, we would have an optimistic view, we would be a little bit more cautious going into 22 and 23, because there's still a lot of uncertainty. There's uncertainty with the vaccine rollout, certainly in Canada, which is well behind the US and other places. And from our perspective, we would say that perhaps markets have gotten just a little bit ahead of where they are, in part because there is the rise of the individual investor. And we all know what's happened over the course of the last couple of months or so. In fact, Travis, you mentioned in your opening that while our business line is NEI Investments, the parent company is Aviso Wealth. And Aviso Wealth is a wealth management organization. We have 4 primary lines of business, one of which is an online brokerage. It's called Qtrade Investor. And Qtrade Investor has been having record months, not just in 2020, but in the first 2 months of this year. And that is in part because of the rise of the retail investor. And we think that's actually a really good thing. We think it's a good thing that individuals are coming into the market. We are a little cautious, though, by some of the volatility that is there. But I would say that from a professional portfolio management perspective, yields have started to come up. The market seems a little bit more balanced. Value has come back in a little bit this year, particularly in Canada, with some of the secular sectors coming back, or the cyclical sectors coming back. But I would say we're still a little bit cautious, because we think markets perhaps have gotten a little bit ahead of themselves, not knowing that there are future issues in the latter half of this year, and then certainly in 22 and 23.
What a great answer. Thank you. So I'm going to pass it off to my colleague to answer to ask the next question. I just want to say, if I call your name, please state your name, what you study, and which organization you're from. So the next question comes from Jessica Ville.
Hi, so I'm Jessica Ville. I'm a third-year finance student from Laurentian University, and also a senior associate for FALU. And I just wanted to say thank you to Fred for being with us today. So my question for you is, for students aspiring to pursue a career revolving around ESG investing, are there any specific courses they could be taking, or things that they could be doing prior to graduation that would benefit them before entering that industry?
Sure, it's a great question, Jessica, and thanks very much for asking this question. I would say, so I'll give you a two-parter, right? The first part is, historically, people would view finance and view investments in isolation of responsible investing in ESG. Increasingly, what's occurring, though, is the ESG curriculum is being embedded in finance courses. Now, I can't speak for Laurentian or some of the other business programs, but I can speak for actually the CFA program. And the CFA program, and for those of you that are actually either considering it or are enrolled in it, you will know that there is now a distinct component around ESG investing. And so from my perspective, that's a great place to start, by looking at that designation. I view it, I'm a passionate believer of investments and finance, and a very, very strong supporter of the CFA program. I would say that for those folks such as yourself who are considering a career in investments or finance, that's certainly a designation to have. And increasingly, the CFA is actually building out its own component of the curriculum around ESG. And the other thing to note is that the CFA actually last year, the Global CFA Institute, and we participated through our association with CFA Society Toronto. They are working towards global standards on classifying and viewing investment products around ESG. And there are a number of other organizations who are trying to do the same thing. Our guidance at NEI is to say, let's see what the CFA Institute has and let's see what their framework is in terms of coming up with some consistent standards across the board and across the global situation. Because from my perspective, what that allows us to do, and it allows both institutions as well as retail investors, is that there is a consistent and global framework. And so you can say if organization XYZ is saying that their products meet these standards, and organization ABC by adhering to a global standard, then you know that you're comparing proverbially apples to apples. So I'm very supportive of that. Your specific question is definitely look at that program, definitely look at that curriculum. There are other master's programs available in sustainable finance. I believe Concordia has one. And from my perspective, though, the interesting thing about your question, though, is that it used to be, well, I start here and then I've got to go and get this on the side. Now what we're seeing more and more is that it's all embedded in one program. So I think you've got a lot of opportunities there.
Thank you.
So for the next question, this participant has asked the moderator asked the question. So it comes from Andrew Malecki of IB Business School and RBC. The question is, how can we persuade fund managers to divest from unethical investments?
That is I'm going to say that is a not so much. Well, I'm going to say it. That's a controversial one, right? Because there are many schools of thought, but there's a couple of schools of thought here, and it kind of gets back to the point that I was raising a little while ago in my opening remarks around personal values, right? I talked about 3 different types of investors who look at ESG. They're the ones that say, I'm looking at it from an investment ESG risk perspective, personal values, and then finally those that want to make an impact. So I'll give you an example. It's a very, very real example, right? There are a number of investors, both professional, institutional, and personal, who will say, we got to get out of the fossil fuel industry, right? We got to get out of the oil sector. And that is a held view. That is a view that they take. And they take that, it's not an irrational view, but they say that will expedite us to move to a cleaner economy, an economy that's focused on renewables. And that is a view that a number of people take. And quite frankly, a number of public sector institutions, both here as well as in the US, have adopted that view. And I would say it is a logical and rational view. The other view, and that is a view that we would have at NEI Investments, is we say no company is perfect. There is no company on the face of this earth that is perfect. And what we can do is we can actually actively engage with companies through our shareholder engagement program and work with them to transition to a cleaner economy. My own personal view, and this is a Fred Pinto view, and hopefully it won't get me fired from my day job at NEI Investments, is we are participants, and especially in Canada, we are participants in the capital markets. And as participants in the capital markets, both buy side and sell side, we have to work with the energy sector to transition to a cleaner economy. We cannot go, there you go, it's your problem, it's someone else's problem, it's the Albertans' problem. We can't say that, right? We have to work with them to transition to a cleaner economy. We've had a long-standing engagement program led by a gentleman named Jamie Bonham at our firm with Suncor Energy. And it's to really work with them to make that transition. They get it. They know where they're going. They know if they don't do anything in 20 years, they're going to have stranded assets. But what we want to be able to do as an investor is to say, look, by 2040 or 2050, we want to get to a target level. And a lot of investors these days are talking about something called net zero, and it's net zero carbon emissions by a certain date. So whether it's 2040 or 2050, et cetera. We want to get to that level. And by establishing that target in a realistic manner, we believe we can actually work with investors to get to that perspective. I did say it's a controversial and a question. It's not so much a controversial question. It's a question that people have some very defined views on both sides, and I would respect both opinions.
Our next question comes from Michaela Sheehan.
Hi, my name is Michaela Sheehan. I'm a fourth year finance student and a manager for the Finance Association of Laurentian University. So first off, Fred, I'd like to thank you for taking the time and being with us here today. It's really appreciated. But what I would like to ask you, so I know you brushed up on it a little bit already, like why do you think ESG investing is more relevant now than it was before? And what are the reasons behind its increase in popularity?
For sure. So I kind of touched on it. You're right, Michaela. Thank you very much for your question. It's wonderful that you asked the question. I would say there's a couple of things. One is professional investors and institutional investors in particular are really viewing this as table stakes. There is a association. It is sponsored by the UN, and it's a ranking that investors and professional asset managers and asset owners they do every year, and it's called the UNPRI, the UN Principles for Responsible Investment. And essentially what it is it allows someone who's looking at an asset owner or an asset manager to say, you are graded, yes, we are graded, like you guys in university, on a number of different factors, whether it is your equity ownership, your shareholder engagement, your process in analyzing equities, fixed income, et cetera, and you're rated or ranked in terms of the robustness of your process around ESG, and it's called the UN Principles of Responsible Investing. And I think this year they're changing up the scoring because there's so many professional asset managers and asset owners who are getting these ratings that I think what they want to do is they want to raise the bar and make it more challenging, which we totally support. And so the reason I'm telling you this is because increasingly large clients, whether they are high net worth or institutions, they are requiring their asset managers to have that certification, and they want much more than that. The level of questioning that they're asking their asset managers around ESG, around their active ownership, is to determine whether or not there's actually something substantive or whether it is just window dressing. And so I would say the rise has resulted certainly from a lot of institutional investor interest, because what they're saying, and it gets back to the first need that I say, is this improves my risk and return profile. What we're also seeing though, Michaela, is the rise of the individual investor. And in part, it's folks such as yourself. It's the millennials and Gen Zs, the group between 18 and 34. And they're saying, look, we get it, Fred, you got risk return, but we want something else. We want to make an impact with our investments. And I think that's what we're also seeing, because as we know, and I think you're probably aware of this, there is the intergenerational wealth transfer, and the boomers have been talking about this forever. I'm not a boomer. I'm actually Gen X. Just full disclosure, right? But the boomers have been talking about this like intergenerational wealth transfer, and there's $30 trillion going to the next generation. Well, what's interesting about that is the next generation wants ESG. They want to say, look, we're not just satisfied with retirement income planning or income planning or financial planning. We get that, we want that, but we also have an interest in what you're doing, in what the investments are doing, and what companies are doing to make the world a better place. So I see those are a couple of primary reasons why. You've got the institutional investor interest there, and then finally the retail investor interest as well.
Thank you. That was a really good answer.
So next question comes from Neil Patel.
Hello, Fred. Thank you for coming out to meet us today. My name is Neil Patel. I'm a third year finance student at Laurentian University and also manager at FALU. And my question to you is, what are some skills or qualities that you look for in young candidates that want to join in the asset management field or industry?
It's a great question. So I've said this. I am a big believer in the CFA program. So if you're going to get into asset and increasingly wealth management, the CFA program is table stakes, right? So you certainly have to have the interest and also the energy to be able to do that program. It's at least 3 years, maybe a little longer. And there's no better time than the present to actually start doing that program. So definitely from an educational perspective, I think that is table stakes, along with a finance degree or something else. I would also say, Neil, that there's a couple of other skills that I would recommend. One is, and I'm not a data guy, full disclosure. I wouldn't even call it coding, what I did way back when. But increasingly, I think having an understanding of that and having an understanding of the power of data and how data can inform decision-making, whether you're crunching the models or whether you can interpret that, is very important. And we all are at our organization big believers in fact-based decision-making, to say, what is the data saying, right? So if we start, and sometimes, and I'll say this, blue sky sessions are tremendous, right? Throwing ideas all over the place, right? I'm not a guy that'll throw ideas all over the place. I like to have ideas anchored in facts, right? And so I would say an appreciation of data, an appreciation of analysis, whether it's yourself doing some coding or being able to interpret that is very important. And then something I think that is equally important is your ability, and this is where the softer stuff comes up, teamwork and collaboration and the ability to influence people to an outcome. No matter what your position is in any organization, or even if you are working in your own firm, whether you're an entrepreneur, et cetera, you have to be able to influence someone. And especially if you're advocating for an idea or advocating for a position, you have to be able to influence. You can only tell someone so many times, you got to do this, and usually that never works. What you're trying to do is you're trying to influence them to say, hey, have you considered this? Or I think this is a really good option, or this may be a different way of thinking on this problem. So I would say those are the skills that I look for. In terms of the last one, your participation and everyone's participation in an association like the Finance Association of Laurentian University. That's huge, right? Because you probably had to influence your team members in getting to an outcome, or in getting something moving along. And so I think that's tremendous. And I would say those are the things that I would look for in someone who's applying to our organization.
Wow, thank you. That was a great answer.
So our next question comes from Priyanka Bhuwania.
Hi, Fred. Thank you for taking my question. I'm Priyanka Bhuwania. I'm a working professional, and my past experience was with Guggenheim Partners in equity research. So my question is that a company which practices bad ESG policies, they are expected to have implications on its financials, operation, and reputation in the long run. But how should we implicate or incorporate it in the financial modeling or valuation in the short run? Like, for example, recently when we had SolarWinds hack, the price took an immediate hit and it went down. But how should one incorporate as an analyst in the modeling to give this impact in the short run? Thank you.
That's a great question, and it's something that I would say. So first of all, I'm not an equity analyst. I do not have your level of experience. So I'm going to give you probably a more of a qualitative answer, as opposed to saying look at this particular model. It's really tough because the question you've asked is really tough, because in the short term, a lot of the ESG risks or factors, as you're likely aware, don't materialize, right? They are looking at sort of a longer term model, whether it's 18 months, whether it's 36 months, or even 5 years. And so it's really hard to actually say, look, whatever my valuation is, I'm gonna take a haircut by 5 or 10%. based on this shorter term risk. The one thing I would say that may be of help is if you have done enough homework with an organization around perhaps what their current policies are and their current views, and you're looking at things that are coming up at an AGM and an annual general meeting, and you know that there's a number of perhaps contentious resolutions that a lot of institutional investors might not vote. So in their proxy voting, there might be an issue there that might temporarily put the stock price down. That could be a factor. But I would say though, Priyanka, that's one of the challenges around ESG. Is how do you account for those shorter term factors? Because most of what we do is over a 3 to 5 year horizon. The other big challenge, and I'm sure you're very well aware of this, is the data is not clean, right? The data is not clean. There are many providers of ESG data. And there's a handful of large organizations out there who have their views on, and I'll just use Apple, right? Have their views on Apple. And sometimes they will say, hey, great company because of these reasons, and others would say, well, not so great company because of these reasons. The company that comes to mind, not Apple, is Tesla. And if you look at Tesla today, and I think you're smiling, I think I can see you smiling, right? There are those that would say on an E factor, excellent, but on the G factor, not so good. And a lot of data providers will have distinct views on each of those companies. And so I think the important thing to do is look at it objectively as an analyst and say to yourself, look, I'm looking at 4 or 5 different data providers out there, but I have to have a qualitative view, right? An overlay, whether it's my own evaluation framework or I'm using someone else's evaluation framework, and then applying what you believe to be perhaps 1 or 2 shorter term factors. Again, they might be impacted on an upcoming AGM or some shareholder resolutions, but something that gives you a little bit more of the art than science. But it's a great question. And I would say it's one the industry struggles with because data integrity and quality can be so different based on the providers you're looking at.
Yes, absolutely. There's so much data discrepancy. Thank you for the answer. I think it's perfectly put down. Thank you.
You're welcome.
So the next question they wanted the moderator to ask. So this one comes from Joe Bradbury of Laurentian. So looking forward in the next 2 or 3 years, what do you think, or which industries do you think are key to grow?
I'm going to give you an honest answer. I mean, if you look back in 2000, or you look back in probably 1980, or you look back in 2000, companies that were the top S&P companies are certainly not the top companies today, with probably the exception of Microsoft, and maybe Apple was getting up there, right? And so when I look at industries that are growing, certainly if I put my ESG hat on, I will say industries that are focused on renewable resources, definitely those types of industries will definitely grow over the course of the next little while. But I would also say that if you look at financial services as an example, we know financial services is going to exist 10, 20, 30, 40 years from now. But the difference that it'll be is the level of integration of the digital experience for a customer is going to be that much more than what it is today. One of the topics, and we talk about this a lot at leadership levels within Aviso, is we are in general behind in financial services some of the other industries, whether they be consumer discretionary, whether they be technology. And what we have to do is to be able to incorporate more customer-friendly, more digital-friendly applications in our businesses to be able to get customers to say that I have a seamless experience, much the same way as I have a seamless experience today when I go onto Amazon, or when I go onto my retailer of choice, I'm doing a couple of clicks and automatically I get sort of an item, and the item will be delivered in a couple of days. So in terms of industries, I'd certainly say renewables, those that are focused on resource optimization, definitely industries to consider. But the whole notion of the digital customer or the digital consumer, that impacts all sorts of industries, and having an appreciation of what that looks like from a consumer behavior perspective will be important going forward.
Next question, Jake Janicki.
Hello. Thanks, Travis, for giving me a chance for this, and for Fred for attending. It's always great to see an Ivy alum out there succeeding in the world. So, it inspires me a little bit more. So in terms of my question, I saw that you have a lot of experience investing on behalf of communities. I was wondering, how have your criteria changed over the years? And if they're ESG related, have you been applying those to certain sectors that maybe had a little bit more room to grow in the ESG environment?
Wonderful. Well, thanks very much, Jake. And Ivy about to be alumni this year, or are you coming up in?
I'm 2 months in. I got a long road to go.
Well, and are they still giving you the cases like left, right, and center, and you're like overwhelmed?
I'm loving it.
Excellent. So it's a great question. And you're right. I've been involved with community associations and community foundations. I currently sit on the board of the Oakville Community Foundation, and so have a view in terms of how they're approaching their investment base. And so I would say there's a couple of changes that I've noticed in the last little while. Before, it was usually all around achieving a certain goal to be able to hit your income stream, right? And usually it was around 3.5%, because I think that's CRA mandated or something like that. We have to be able to get 3.5% out of our foundation. And it was all about coming up with the right asset mix to be able to deliver those returns. And what you would have experienced is, and this was the rise and certainly the dominance of the university endowment funds back in the 90s and going into the 2000s, is getting into alternatives, right? And suggesting that traditional public equity asset classes weren't going to give you the returns to be able to get that income stream and more, and so therefore you had to look at alternatives. And to me, it was the progression from looking at just kind of a basic 60-40 model, or 60% equities, 40% fixed income, and saying, well, that's not going to get us where we need, especially if rates go up as they're going up right now. My bond return might actually be like flat, and this year that's a very real possibility. In fact, it's a real possibility for Canadian fixed income that you might actually get a negative return if we're not able to clip my coupon and yields are on the rise. And so that was probably in vogue, I would say, certainly in the late 90s, 2000s, and even in the 2010. What I've noticed now, and this is probably a little bit more associated with smaller community foundations, is and this is in part because markets have been very strong, is we're less worried about the returns, but more concerned about how do we make an impact? And it gets back to one of those points I raised. And a number of community organizations or community foundations, and certainly this is the case of the Oakville Community Foundation, is we look at impact investments within our own communities. And we have a small allocation to some private investments here. And to us, it's a tangible and visible demonstration of the impact that we are having within the local community. And as an example, I mean, those that contribute to community foundations or other grassroots organizations, they do it in part because they want to give back to their communities, but they also want to know that they're having a positive impact. And so what I have noticed, Jake, is that it's probably less about the return objective and more now around that making an impact objective that I talked about earlier on in my comments.
So our next question comes from Caleb Pichet-Larocque.
Thanks, Travis. This question is a little bit more specific. I'm wondering have you read the book The Corporation?
I have not actually. I have not.
Okay, well, you talked a little bit earlier about how you see a shift from shareholder maximization to stakeholder maximization. This book is a little bit outdated now because it was written in like 2004, I believe. But it makes a case that just to be the devil's advocate here, it makes a case that it is actually illegal for corporations to want a better society unless there's a direct benefit to shareholders. And they state a few cases that have been to the courts where the courts have proven that to be true. One of them, for example, would be Ford and the Dodge brothers. Ford wanted to lower the price of cars. The Dodge brothers wanted their share, their dividend. They went to court and the Dodge brothers won. That's just one of them, for example. So I'm wondering where you think how true that is still nowadays, and where the ESG investing actually meets that issue in the courts.
Sure. So, as I said, I have not read the book, so I'm going to give you somewhat of a quasi-ignorant answer because I haven't actually read that book. But what I would say is that it appears to me that that's somewhat of an outdated view of corporations today. Corporations, and yes, there's definite issues with companies and corporations, and for sure, as I said, there is no such thing as a perfect company. But by and large, organizations have really evolved, certainly starting in the 2010s. And the fact that the Business Roundtable in the US in 2018 made a pronouncement around stakeholder primacy versus shareholder primacy is a huge deal. I have colleagues of mine, and they will say every year for the last last couple of years, Larry Fink. So Larry Fink is the CEO of BlackRock. BlackRock is the largest asset manager in the world. And so, yes, I'm giving a BlackRock plug, even though I'm from NEI. But what I would say is that when Larry speaks, people listen. And what he has talked about over the last couple of years is he has said the responsibility of companies and of asset managers is to move towards a better outcome. And that better outcome is anchored around ESG. And so I'm a firm believer, I'm an optimist to say that organizations are evolving dramatically. They are, quite frankly, getting it. And one of the great pieces, a colleague of mine, John Bay, who was our chief investment officer, he circulated this piece around earlier this year, and it was based on last year's 2020 data. And it was actually a piece that was created by Edelman, and it was the trust index, and they do it every year. And last year, for the first time, what we noticed is that CEOs were actually ranked very highly on the trust factor by a broad base of participants or people or survey respondents. And what that shows to us is that organizations, companies have an obligation, and that obligation goes much beyond what maximizing shareholder value is. And people are taking it seriously. And what we're noticing, obviously, is that the consumer or the investor, whoever is buying that organization's products and standards, view that CEOs have that obligation and that responsibility, and they're demanding that they fulfill those requirements. So are there bad companies out there? Yes, definitely, 100%. Our view, though, is that most companies are kind of getting it. We want them to get it much faster, but they're certainly moving in the right direction.
Do you believe these corporations are changing towards ESG activities because investors want them to, or because they want to do good to society?
I think it's a multi-layered. I think both, right? I think they're getting it. I will say this, and my ESG colleagues know this, and they remind me of it every day. They say, Fred, we're in demand. We're in demand. One of the fastest growing careers is in the ESG space. And right now, what is very apparent is the views and the discussion is at the C-suite level. Before it was within and organizations. Some still have that. It's called corporate social responsibility, CSR. ESG would be like kind of packaged off to there. Well, let's give it to the HR people, or let's give it to the CSR people. They'll deal with it, because it's all about soft and making people feel good about themselves. Well, that's 100% changed. Where the discussion is today is it's at the C-suite level, and lots of organizations are having very substantive discussions around sustainability.
So the next question comes from Emily Plater.
Hi, Fred. Thanks so much for being here. My name is Emily Plater. I'm in my 4th year of BBA at Laurentian. I'm also a manager for FALU. So my question for you kind of surrounds greenwashing. So as the popularity of ESG investments continues to grow, and since it is kind of a newer trend, there are less regulations surrounding greenwashing. So I'm wondering how we as investors, what we can do to avoid it, or what you at Aviso do to avoid greenwashing.
Great question, Emily. And I will say this. So if you notice, there's a change in my background here. It's because the sun's peeking out and then it goes away, it peeks out and goes away. So there's a little lighting thing happening here with my background. So greenwashing is a huge issue, right? It's a huge issue for the industry, and it's a huge issue because there are no standards today. And especially if you look at the marketing language around responsible investing and ESG, it all sort of sounds the same, right? And I joke about this with my colleagues. I'll say, folks, let's close our eyes. Let's read our let's close our eyes and have someone read like marketing materials from various organizations, and they all kind of sound the same. And the real issue is, so what are you actually doing? What is the robustness of your program? And so it comes back to two things. For an investor, when I look at ESG, what I want to know is, how are you selecting securities? What is your data process? What are the positive screens that you have along with the negative screens? Everybody always talks about the negative screens, no alcohol, no tobacco, et cetera, et cetera. But what are the positive screens? How are you factoring those elements in? How are you truly integrating ESG into your investment process? Can you give me an example? What's your view of Tesla? What's your view of Apple? What's your view of Alphabet? There's digital privacy concerns with Alphabet and Google, right? Tell me a little bit about that. And then finally, what we would want to know is, how are you actually engaging companies? Are you just applying a pure quantitative approach, coming up with a score, or are you actually then elevating your program and having an active ownership program? And then finally, are you actually engaging with policymakers, and particularly the regulatory authorities, because we know the regulatory authorities are looking at this stuff to have investors achieve a better outcome. And so from my perspective, that is what you need to be able to do to assess the robustness of a program, because you're right. If I just look at marketing materials and brochures and all the glossy stuff that comes up, everybody talks about this. Everybody talks about being a leader in responsible investing, but you have to actually open up the cape, look inside and say, how are you actually applying that rigor in your investment process? And I would say a partner, and if an investor can't do that, make sure that the organization that they choose to look at this has that robustness of a process that I've talked about.
Thank you so much.
You're welcome, Emily.
So I'd like to say, on behalf of everyone here, thank you so much, Fred, for your time today.
You're very welcome, Travis.
We loved having you.
Thank you, Fred. That was awesome.
Thank you, Fred.
And
Thanks,
thanks to everyone for coming as well.
Absolutely.
Great job, guys. Have a good day.
Thank you.
Thank you.
Have a good one.
See you later, Fred.
You as well.
Thank you, everyone.
Thanks for the event, Travis and team,
No
Laurentian. Great job.
Thanks, Jake.